Hello, my name is Dr. Jared Pickens. Today we'll be presenting on credit. This is brought to you by the College of Business at Texas A&M University Commerce and the United States Department of Agriculture. Here's a little bit of information about myself if you care to learn about it. So our topics today. First thing we're going to talk about is our credit reports, just our individual credit reports. We'll talk about checking credit. We'll look at credit scores and the formula that is used in order to determine the score. We'll look at how we build and maintain credit. And then finally, we'll wrap up our presentation with talking a little bit about identity theft, the statistics, how thieves go around stealing identities, and finally, we will end with some ways you can safeguard yourself from having your own identity stolen. Just to notice that all the information provided today is just for educational purposes only. So, first of all, let's just remind ourselves. I know most of us already know this, but let's remind ourselves why credit is important. Guys, it's just a fact of life, right? Anywhere you go, the bank, your auto insurance, even getting a job, today it requires either good credit or not having bad credit. And the last one's more towards that job, especially if you're entering some type of job in accounting, the financial services area, something like that. Remember that no matter what some individuals might say, your credit is very important. It could cost you substantially in additional auto insurance premiums. It could save you on mortgage interest rates. So it just depends on your credit worthiness and what I like to call your financial report card. So remember, establishing and maintaining a healthy credit report, it's just kind of a part of life, and the score too. And it's become more important since the Great Recession. Banks now understand even more the requirements that they need to put forth in making sure that they don't have such high defaults moving forward. Remember that both lenders and insurance companies expect individuals to have strong credit today, and we'll talk about specifically what is a good credit score, what's even an excellent credit score. And remember, employers today also have the right, with your permission, to check your own credit. So let's first talk about credit reports in general. Now, a lot of people think credit reports and they automatically jump into the credit score. While credit score is very important, the credit score is calculated on the items that are on your credit report. So let's start there first. So your credit report contains your credit history as reported to the credit reporting agencies by lenders. In a little bit, I'll show you a graph of how that's reported. So it's by the lenders who have extended credit to you. They report if you're keeping up with your promises. They report also how much of the credit you're using. And they report that to the 3 credit reporting agencies. Like I said earlier, consider your credit as your financial report card. You remember your report card from your days in grade school or high school or even your college transcript. This is something that other individuals are going to take a look at. And it's something that you want to make sure that you're proud of, and it's something that shows that you're responsible and that you can be trusted. So establishing and maintaining credit is important, and like I said earlier, it's a major part of your overall financial health. So what's on a credit report? Well, we're going to break it down into 4 different categories, and I'm also going to show you today an example of the credit report. Now, many of you have seen a credit report before, but there's some things in the credit report that I'd like to go through today to maybe help educate you on some things that you may not truly understand about them. So the first thing we're going to look at is personal identifiable information, or the PII. We'll look at credit accounts, credit inquiries, and public records and collections. So these are our 4 categories. So your personal identifiable information, that's going to be your name, your address, social security number, date of birth, and your employment. Now, your employment, you'll notice if you do pull your credit report, will have your current employer and it may also have your past employer. Now, it's always important to make sure that this information is correct. Now, my name is Jared Pickens, and there are, the last time I checked, about 8 different first, middle name, and last name in the United States. That seems kind of crazy. You wouldn't think that that would be um, that number, but it is. And so if you think about that, the 3 credit reporting agencies and also the financial firms and insurance companies that report data to those credit bureaus, remember that they make mistakes. Sometimes data files get crossed over and reported on the wrong person. It's happened to me. It happens to other individuals. So making sure that your PII or your personal identifiable information is up to date and accounted for, that's important. Your credit accounts, probably and arguably the most important. It's reported by lenders and includes your credit card accounts, auto loans, student loans, real estate loans, etc. It tells, if you pull your credit report, it'll tell you, over the last year, how many times you've made payments. It will tell you if the payments have been on time, if they've been late. If they've been late, then how many days have they been late? 30 days late, 60 days late, 90 days late. We'll talk about why that's important here in just a little bit. So your credit accounts are very important, and again, those are reported by your lender back over to the credit reporting agencies. Credit inquiries. So credit inquiries is where someone, some entity, whether it's an insurance company, an employer, or maybe you're applying for a mortgage, okay, that they have actually looked at your credit report and they have calculated the risk that you might, in not paying your loan back or not repaying the auto loan or credit card debt. And so they come up with the interest rate. And that's a credit inquiry. They're looking, they're evaluating you. And so we break these down into 2 different categories. Number 1, a soft inquiry. Number 2, a hard inquiry. So a soft inquiry, it's really important that you understand the difference. There are a lot of times when you will receive a solicitation in the mail for a credit card. That is not on your behalf, right? You didn't actually go out and request your credit to be reviewed. In fact, it was the actual company that uses your credit that solicited you. Okay, that's a soft hit. Yes, they did review that. You can see that on your credit report, but other lenders can't see that. Another example of a soft inquiry an example of a hard inquiry, on the other hand, is if you decide to go buy a new car, you walk up to the car lot and they run your credit at that point to determine your interest rate. That's a hard inquiry. You walk into a department store, they tell you you can get, hey, we're doing 0% off or some kind of special today, and you apply for a card. That right there is a hard inquiry. It's you that actually requested that your credit be checked. The important thing to understand is in a little while we will talk about how getting your credit checked, okay, applying for some type of loan, that actually can have, if you do it too much, it can actually have a negative consequences on your overall credit score. So that's important. Public records and collections. So there is a part of your credit score where you any type of debt that you didn't take care of. It could be a credit card. It could be a utility bill. In major metropolitan areas, we have toll tags and tollways, and if you don't pay those, it could be charged off. But all of these that are sent to collections, they also appear on your credit report. Any type of judgment, lawsuit, lien to, can also be put on your credit report. Bankruptcies are also included. Bankruptcies, will stay on your credit report approximately 10 years from the day you filed. And so that is something to keep in mind. If you do have something that is past due and it does go to collections and it does appear on your public record and collections, that can stay on your record up to 7 years. And however, with new FICO reporting measures in your calculation of your credit score, which we'll talk again more about later, that won't be included if you take care of that public record or collection. So you make it whole, or you come to you pay that balance off. So just remember, one good example I can personally tell you is with a internet company. We moved and we thought we owned the modem. Well, we didn't, and they had tried to reach out to us and get it from us, and they couldn't. So the next thing we noticed is that was on our credit that we owed them a couple of $100 for an internet modem. Well, we reached out and we worked it out, and it was taken off of our credit. So anyway, that's just an example I wanted to provide you. So, believe it or not, and I know there has been historically a lot of great commercials telling you to check your credit at certain places, there's only one federally approved website for you to check your credit, and that is annualcreditreport.com. Okay, that's the only federally approved site. You can get one copy of your credit report from the three credit reporting agencies. So that's Experian, Equifax, and TransUnion. So one thing you might do later in the presentation, we'll talk about identity theft. And with identity theft, what you could do is you always want to make sure that your credit report checks out, so that you're like, well, hey, I'd never applied for this loan, or I don't have this credit card. Well, then you need to take action and work with the Federal Trade Commission. We'll talk more about that in a little bit. But with this example right here, or this topic right here, you could stagger those three reports, and you could do one every 4 months of the year, right? And that way you're using each one. Now remember, each credit reporting agency of the three, Experian, Equifax, and TransUnion, they might all have a little bit different data on you, right? So, for example, let's say XYZ Financial issues you a credit card and they only report to Equifax. Then that means Experian and TransUnion don't know about that, right? Or let's say, worst case scenario, your identity is stolen through a company that only reports to Experian. Well, you're never going to see that if you're only pulling through Equifax and TransUnion. The good news is that a lot of the financial firms out there, insurance companies, they all report, all of the lenders report to all three. A lot of them, not all, a lot of them do, so they will. But there are a few that only have relationships with one of the three or two of the three. That's why it's important that you check all three of them. So your credit report is absolutely free, right? You can pull one from each of the three credit reporting agencies, but there is a small charge to get your credit score. Now there are other websites. There are other very reputable websites. Even your bank. When you're shopping for a bank service, the one thing that you want to look for today is not free checking. Everyone offers free checking. But what a lot of banks are offering today are free credit monitoring services, and they're also offering clients updated credit scores as well. Okay, so we'll talk about credit scores in a moment. Now, just so that we understand, before we get into the credit report specifically, I want you to understand the relationship that we have here. This relationship that we have is we have FICO. Okay, FICO stands for Fair Isaac Corporation. The last names Fair and Isaac are the two gentlemen that came up with what we know as today your credit score. In fact, they were sitting around saying, hey, there must be a better way that we can gauge people that they have, a strong credit worthiness or a low credit worthiness. So they came up with this system, and there's been multiple revisions over the last couple of decades. But what happens is that your lender, that would be who owns your, you have your credit card with, your auto insurance, um, uh, primarily your lenders, are going to report this information to the credit reporting agencies. Okay, the credit reporting agencies then can use FICO calculation, right? And that FICO calculation then goes back down to your lender. Okay, so what happens is that new lenders start using your FICO. Okay, and so that's kind of how the relationship works here. They all kind of work together. Okay, so your credit reporting agencies are going to be the ones collecting information from lenders and then using it to calculate your FICO score, which is also sometimes called your credit score or your Beacon score. And then the lender can make another decision on, hey, do we want to offer credit to this individual? Now, the first thing, I want to give you a tool here, something that I share with all my students or any presentation that I give, and this is optoutprescreen.com. So later in the presentation, we'll talk about identity theft. And still, one of the top ways thieves steal individuals' identities is by dumpster diving, right? So I know none of us really want to receive pre-approved letters all the time. Well, you can actually make that stop. Actually, there's a federal website called optoutprescreen.com. And if you opt out, and you can do that online for 5 years by just clicking a button, typing your social, then that's going to drastically reduce the amount of pre-approved offer letters. And the important thing about that is, number one, it removes any type of you know, uh, it removes some type of chance for you to sign up for a credit card that you may not want or some type of financial item that you don't need, right? They're soliciting you for a reason. They're reviewing your credit report and they're saying, hey, we think we can make money off of this individual. Now, that's not always bad because they might be able to offer you a great service. But the biggest issue with this is, number one, well, not the biggest issue, but it's annoying. All right, that's one issue. Number two, it lowers the junk mail. And I know what many people do with junk mail. They just throw it away. Hey, it doesn't have my social security number on it. It only has my name and my address. But an identity thief, if they come, they'll keep coming back for more and more and more pieces of information. So if you can reduce the amount of junk mail that you get by 70 or 80%, then that's going to reduce the chance of identity theft, right? Especially if someone even reaches in and steals your mail. So that's just something I wanted to share. So let's look at 4 pages real quick of an Experian. This is from their website, an example of their credit report. So this is their credit report. And again, we've got our personal identifiable information here. This one here is showing their credit score. Again, your annualcreditreport.com is not going to show that immediately. That is an additional charge. But this is something where you want to make sure that your Social Security matches, your name's correct, your address, and if it's not correct, then we need to contact the credit reporting bureau. So in this case, that would be Experian. So this is very important. This is your account history. So it shows every single type of account like we talked about. Here, this person has a real estate mortgage. They have, looks like an installment account, so it's probably an auto loan. And they have Jaguar credit. We know that really probably is an auto loan. We can tell right here, auto lease. So this is some other type of secured loan. It tells you all the information that you need to know. It tells you the terms, it tells you what it's for, the balance, and the original amount. It tells you the scheduled payment. All of this information is used in the FICO calculation. and we'll talk about that a little bit more, but they look at your minimum payments. So all of this needs to be correct. Now, one of the items that you really need to understand is this item right here. And this is the monthly reporting or payment history of about 20, this is showing up to 25 months on their records. And you can see C represents current. Now, one common misunderstanding is, let's say that your credit card bill is due on the 5th of November and you don't pay it until the 6th. Yes, technically you are late with that credit card company and they're going to charge you a fee, probably a late payment fee. Go ahead and give them a call. They're likely going to remove it, at least if it's your first one, maybe even your second. But that doesn't mean that you were late in terms of your credit report. Your credit report won't be deemed late until you're 30 days past due. And later, what we'll show in the calculation is that making payments on time for your credit score is the number one thing you can do to improve your credit, build credit, maintain credit. So if you're past due, it will show 30 days past due. If you're past due 60 days, well, that is going to hit you harder, and it's going to show it here, 90 days. And then it will show also if the account was closed by yourself, or if it was charged off, right, or sent to collections. So the account history is really important. Inquiries. Remember, we talked about two different types of inquiries on our credit reports. We have soft and hard. So this is right here, a mortgage reporters. They have a mortgage, these individuals. And so Greenpoint Mortgage is going to check their credit from time to time to see how they're doing, because they want to know how many of their clients are becoming a little riskier. Maybe they're financially struggling. That lets them understand the risk that they have with their current portfolio of loans. In this scenario right here, this would be considered a soft hit. Let's see here. These are very similar things. I don't see Equifax Mortgage Services. See, these are all what I would consider soft hits. There's nobody out here, for example, XYZ Credit and Seeking Credit Card. So these are all soft hits. Finally, remember that your public records, okay? And one thing we can see here is bankruptcy. A Chapter 13 petition was filed. All right, you can see that that was their 13 petition was filed, and it was actually in 2008, and it was actually dismissed in 2012. You can see that there's actually a judgment here of $500, and so meaning that there was some type of judgment in Clayton County. And then you could also see here that there's a lien, a state tax lien that's represented here on the credit report. So all of these items can go on your credit report, and lenders will see that when you're applying for loans, and so it's important. Also, medical debt commonly pops up here as well. Discharged medical debt that went to collections. One important rule, there's a lot of different rules out there, right? Laws, rather. The Fair Credit Reporting Act, the Truth in Lending Act, the Card Act of 2009, they're all important. But the one I think is important for this presentation specifically is that you know your rights underneath the Fair Credit Reporting Act. In fact, the Fair Credit Reporting Act is the reason that there is a federally approved website called annualcreditreport.com. And it's the reason that you can get your credit report checked for free. Before that, it wasn't a thing. So it gives you the rules for credit reporting bureaus and businesses. So we're going to look at both of those that report to the bureaus. So what are the rules that they have to follow in order to make sure that your credit report is as clean as it can be? So let's first talk about some dates. So bureaus must correct or delete inaccurate information within 30 days of any dispute that you have. So if you found some personal identifiable information that was incorrect, they must delete that inaccurate information within 30 days or fix it. If there's an account that they can't prove, by that I mean the bureaus, Experian, for example, then Experian must discharge that if they cannot find more proof of that account ever existing. Okay, so they must correct or delete inaccurate information within 30 days of your dispute, or up to 45 days if you send additional information after submitting your written dispute. Okay, so important to understand that they've got to act in a timely manner. In the past, it was just up to the good faith of the companies or the bureaus. There was no government oversight in that area. So, bureaus must remove negative information more than 7 to 10 years old, depending on the specifics. Again, remember, bankruptcies tend to stay on there for 10 years, and charge offs, that means it could be discharge of medical debt or a credit card, that must be removed at 7 years. If you take care of that sooner and pay those balances off, it could be removed even more due to new FICO reporting requirements, and that's on the score side. So remember that bureaus must provide your credit report to employers, but only can they do so with written consent. Now, the downside to that is that you refuse a potential employer letting them see your credit, then you're probably not going to get the job. But it's nice that you have this kind of protection now. And bureaus must give you the opportunity to opt out of pre-screened offers, which we already spoke about. So let's look at the business side. We looked at the bureau side, so let's look at businesses. They cannot report inaccurate information to credit bureaus. They must maintain good practices in reporting data to the 3 credit reporting agencies. Businesses are required to modify a credit bureau when you have voluntarily closed a credit account. Important. Not just that you closed it or that the business closed it on you, but if you have voluntarily closed that account, that's something you need to check back on your credit report. Hey, wait a minute, I closed that account. They didn't close that on me. So businesses must notify you if you have been denied credit because of information in your credit report. Not only do they have to notify you in writing, they have to tell you why that you received a denial. Or if it's an auto or homeowners insurance company and you don't get their top insurance rate because your because your credit didn't meet their requirements, they have to tell you why. So most likely you'll see things like very limited credit history, or you might see credit balances are too high, right? And those are things that it's nice because it lets you know what you need to do in order to get a better insurance rate, or it lets you know what you need to do in order to get that credit card or get that mortgage that you want. Before this, we didn't have any of this information. So businesses must, and then you have an access to get your credit report and go through and take a look at it. So businesses must provide you with contact information of the credit bureau who supplied the report used in the decision to turn you down. That will be on one document that's mailed to you. Okay, so they'll tell you you've been denied, they'll tell you why, and they must also tell you which credit bureau they used. For certain things, they may only use Equifax, and for other things, that financial institution may use Experian. It just depends. So, what everyone typically wants to talk about is not necessarily the credit report, it's the credit score. So, what we're going to look at is we're going to talk about the credit scores. So, if a credit score is going to tell you, it's going to tell lenders about your credit worthiness. Okay? It's a calculation, it's your financial grade. Okay? Is it an A? Is it a B? Is it a C? It's just not calculated, or that data is not presented in that method. The score provides lenders with a method to calculate the risk. So banks, auto insurance companies even believe that the better your credit score is, the less likely of a chance you'll have some type of accident. Some people think that that is a poor practice, and that's been beaten up a little bit by consumers, but it is what it is, and that is something that they're using today. Now, again, we talked a little bit about FICO, but the most widely used credit score are FICO scores. Okay, and that's by the Fair Isaac Corporation. Okay, and that is like over, I would assume 90% of calculations are based on FICO scores. Now, when I'm talking credit scores and credit worthiness, we're talking at the individual level. So the range of credit scores are between 300 and 850. The higher you are on this, the less likely banks feel that you might default or not pay on what you promised, right? They feel that you're going to make the mortgage payment. They feel that you're not going to walk away from the credit card debt. And so, in doing so, they're going to reward you with a lower interest rate. So, a quote unquote good credit score, it's kind of a wide range, but it's considered to be in the 670 to 739 score range. So I want to show you a chart here, and this is from Equifax 2019. This is the average credit scores in the United States. In 2012, it was around 693, and you can see that now we're up above 701 to 703. So the average credit score in the United States is sitting at a 703. Credit scores, and it makes sense, they've tend to followed economic conditions related to employment and GDP. If unemployment is high, for example, if we see the 2008-2009 Great Recession again, well, we're going to start seeing credit scores go down. People are unable to make their payments. Americans continue, even post the Great Recession era. We've already gotten back up to the debt amount that we had, and it's not real sure that Americans really learned their lesson in terms of getting overextended. Now, if you want to know and want bragging rights within your independent state, then the state of Minnesota and most of the North America, the northern states of North America, they tend to have the highest scores, and Minnesota is the leader. Just for because we're at Texas A&M University Commerce, we're in Texas. Texas is sitting at a 680, so we've got to do better. We're 53 points behind Minnesota. So credit scores. This is the average credit scores by age, and it makes sense. Those individuals that have went through life and that are understand how to play the game a little bit more, those individuals are sitting at about a 750 credit score, so 60 years old. Ages 50 to 59 are at 706, 40 to 49 at 684, then we have 673, and then our youngest individuals, 20 to 29, are sitting at a 662. And so the older you get, the better the credit score you have. It might be because you're learning, but it's also because there's a certain amount of your credit score, which we'll talk about in just a moment, that requires it's calculated based on the length of your accounts, right? So the longer, the older you are, you just have more credit history in general. So there's a positive relationship between age and the credit score. So Fair Isaac Corporation breaks down their categories in terms of poor to exceptional rating of your credit score. They break it down into 5 categories. Below a 580 is poor. Between a 580 and a 669 does not mean you have bad credit. It really just means you have fair credit. But it's still below the US average, and you're not going to get the prime rates. You're not going to get the preferred credit cards of most individuals. You're not going to qualify for a conventional mortgage that is not going through FHA. Okay, you're going to want to have that at least in the good area, and typically you're going to want to you're going to want your credit score to be at least around a 700. And so the credit score is this area is near good, is near or slightly above the U.S. average. And then very good, 740 to 799. That's the credit score that is above average. This is where you want to aim and always kind of be in. If somehow you fall in this area, but you're still in the 700s, not the end of the world. And of course, as you get older, and as you have cleaned up your credits and paid off a mortgage, wow, that shows a lot on your credit report. This is going to help boost this into the 800s. Okay, so remember the maximum score is an 850. So how is this credit score calculated? So how do they come up with an 800 or a 750 or a 700? Well, this pie chart, the one thing you'll notice here is on-time payments. That's what it's all about. It's not about even if you're paying the more than the minimum amount. Always make sure you're making the minimum payment. That's 35% of your score. In fact, there are two items here, on-time payments and capacity used, that represent 65% of your credit score. 65% just in two categories alone. And with that, the second one is capacity used. So for example, let's say you have a credit card with a $1,000 credit limit and you charge, and that's the only card you have, and then you go out and you charge $900 on that card. All right, now if you only make your minimum payments, that's fine. You're making your on-time payments. But now you're using 90% of your capacity, or what I call, or what other individuals call, your credit utilization. You're utilizing a lot of your credit. That is a red flag to lenders. They don't like to see it, and that's where you start dropping in your credit score. Kind of a rule of thumb, and it's not perfect, is you never want to, and this is both on all or each individual card and the sum of all your available credit together, aggregated, you never want that to be more than 30%. So back to the example of $1,000 available credit, you would never really want to keep a balance of more than $300 because that could have a negative effect. Now remember how I said older individuals, they have a longer history, and thus they probably have a higher credit score if they've done the other things that are important. So the length of history represents 15%. Okay, so the earlier you get a credit card, the longer the history that you're going to have. So the credit history is very important. Past behavior doesn't always predict future behavior, but the more data that the banks have and insurance companies have, well, that lets them rest a little easier in knowing your pattern. 3 years of on-time payments is great, but 20 years of on-time payments, that record, that's really powerful. That's going to offer you really good rates. New credit. Again, this is our hard inquiries. This is not you checking your credit. This is not someone soliciting you a credit card offer or some type of a loan offer. This is you actually walking up, trying to buy a car and applying for credit, or you going online and applying for a credit report, or credit card, not credit report. Types of credit. Types of credit represents 10% of your credit report. So they want different types of credit. So how do we break those out? Well, installment credit, right? Installment credit would be auto loans, student loans, which are reported, and it could also be real estate accounts. It could also be credit cards. So they want to see different types of accounts on there. So the next thing I want to talk to you about is, so now we understand credit scores, we understand how they're calculated, we understand what's considered a poor or even up to an exceptional credit score. We now understand how Americans fare in terms of our credit. We even know that Minnesota now is the state with the best credit score. So, but let's talk about three different categories here. First one being building your credit. Second one, maintaining, and third, repairing. The interesting thing about this is they're all kind of the same. You kind of do the same thing on all of these in terms of building, maintaining, and repairing. And if you think back before we get there, A lot of it's built based on this formula here: making payments on time, reducing the capacity used, right? So, so building credit usually requires individuals to acquire debt and pay the debt off. It's a catch-22. It is what it is. That's the game you have to play. So, there are multiple ways to build your credit. If most college students that I work with, the things that they do, or young individuals in general, they don't have to be in college, they look for a small limit credit card. Why I mean small limit? That means the available credit. Most banks are willing to offer or extend credit to someone with no credit for a sum of maybe $500, right? And so by doing that, and then also finding some kind of expense, maybe it's a cell phone bill or a monthly Netflix charge, or something that is a fixed cost, right? Some kind of fixed expense, and then paying that off every month, that's going to start building that payment history. And if you recall, the payment history that we saw underneath our credit reports, the credit report example that we used, that's a great that's exactly what it would look like. So you want to make those payments on time. Now, with a $500 credit limit, if that's the one you get, or you get approved for 1,000, remember it's very easy, okay, to not have control with the credit card, especially when you're young. So maybe not carry it around with you. That'll deter any temptation that you might have in terms of spending money that you didn't plan on using. And remember, if you have a $500 credit limit and you spend $250 and you are then going to make monthly payments on that, you've now got your debt utilization or your credit use, which represents again 30% of your credit score. You've now got that over 50%, and that's going to impact. So you want to keep that down low. On credit cards, you want to look for credit cards with no annual fee. You really don't care about the interest rate on the small limit credit card in building your credit, because the goal is to have that paid off every single month. So by paying that off every single month and within your grace period, okay, before interest starts accruing, then you're not going to have to worry about the interest. So you would much rather have no annual fee than having a lower interest rate, because that's really not important. As your credit score builds more and more and more, then guess what? Then your interest rates are going to start going down. If that company doesn't want to lower your interest rate, well, then you can go find a new bank that will offer you a lower credit card. Now, one thing for individuals who cannot get a small limit credit card or don't want a credit card, there's a secured credit card. It works very similar to a debit card. And really all it is really a debit card that reports to the credit reporting agencies. The only thing you want to be careful with this about is that sometimes the fees can be very high. So there are multiple different types of cards out there. Just make sure that the fees that they charge, the monthly fees, are not astronomical. Make sure that you do your due diligence and your research and find something with a low fee. And so that's a secured credit card. Again, it acts like a debit card, and you put money on it, and you then it reports activities to the credit reporting agencies. You can always use a cosigner, right? And so, for example, if you want to buy a new car and you can't qualify for it, by someone co-signing with you, yes, you both share in that responsibility of the loan being paid back and that payments are done in a timely manner. However, caution to the co-signer. If you co-sign for something, be prepared to own that debt, because when you co-sign on the debt, it also shows up in your credit report. Okay? And so for both the primary borrower and you being the co-signer. All right? Because eventually, if that when it comes down to it, if the individual that you're helping out doesn't pay, then you're required to make those payments. And if also that individual misses payments, is late on payments, unfortunately that shows up on your credit report too. So you really want to make sure that if you are going to go this route and help someone out, which I typically don't recommend, that that you make sure that this person is trustworthy. There is the old rule about the authorized user method. So remember, if you, for example, have a credit card and your child is now 18 years old or heading off to college, and you want them to be an authorized user on your card. The authorized user method can, in some situations, start. It will report that the balance. It will report the for the authorized user on their credit report, and it can show some of the history and future history of the card. Some credit bureaus and lenders report this data, some do not. But that is one method that you can use. There is something called the credit builder loan, and it's probably the last item you want to do, just based on the information and the research that I have. It can be a little expensive, but basically, you're taking out a loan and you're paying that back every single month with interest. So you're really not getting anything out of it, it's costing you. Again, it's one of those negative things, to have to, like I said, you sometimes have to take out debt and pay debt off in order to start building credit. And so that's one thing to consider. And so that's the credit builder loan. I think a good research in all these areas will come up with the best recipe on how you're going to establish credit. Now, once you've worked really hard in building your credit, you have to maintain it. And it's really simple. When we maintain our credit by making sure we don't go over our capacity used, right? That we're not out there trying to get new credit all the time, but primarily that we're making our payments on time. Okay? One rule of thumb is that it is a bad practice to cancel credit cards, primarily because it can delete your available credit. So, for example, let's say you had two credit cards, both each with $500 of available credit. And let's say that you have on one card $200 charged on there that you're paying off each month. Well, you're only using 200 out of your overall $1,000 worth of available credit. But let's say one card you're not using and you don't want it anymore and you cancel it. Well, now you are using, and let's say you cancel the one that you don't have a balance on because you're not using it. Now you're using 200 out of 500, and now your credit utilization rate is 40%. Okay, so making sure that you keep that in mind. Maintaining your credit. Some people, just you don't really have to worry too much about it. Do the small things, but if you're getting ready to move or you're going to buy that first house, this is where you really want to make sure you're not opening up new accounts or charging a lot on credit cards or having anything sent to collections, anything negative before a new purchase, because you want that prime rate on that mortgage. Okay, you want the prime rate. You absolutely don't want to do anything that could jeopardize even going from 4% up to 4.25% over a 30-year mortgage can be considerably expensive in terms of interest. So again, always make your payment on time when we're maintaining our credit. Never use more than 30% of your available credit. Co-signing on a loan for someone can be negative for the obvious reasons. They may not pay the debt, they may make some late payments. But it also can affect how much debt that you have, right? So if you co-sign on a child's auto loan, right, and then you go out and you apply for a mortgage. Well, now that auto loan is going to show up because at the end of the day, it is your responsibility, even though your son or daughter might have taken care of this loan for the last 2 years flawlessly. it's still going to affect it. So keep that in mind. Avoiding canceling cards. So repairing. There's a lot of companies out there that will say they can repair your credit. Well, to be honest with you, they're just going to recommend and do the things that you can do on your own. Okay, so the first thing you want to do is find out why you have bad credit. So obtain your credit report from all of the three bureaus. Okay, so again, hiring a service usually won't fix your credit score. Work with collection companies. Okay, they bought this debt, right? They bought the debt for pennies on the dollar. So if you didn't pay $1,000 on a credit card and your credit collection area or your collection account, there's a collection account for that for $1,000, probably a little bit more with penalties, interest, and late payment fees. Let's say it's now $1,200. Well, that collection company likely bought that for pennies on the dollar, maybe $500, and negotiating with those credit card companies. Now, remember, you did use $1,000, so you probably do want to pay back the $1,000 from a philosophical standpoint. But that doesn't mean you can't be smart in terms of asking the collection company to go down on the cost. Okay, also having them remove any type of late payments, accumulated interest. That's something that they're willing to do. Start building that the credit account history again. Okay, so that means if you have to apply for a credit card, maybe you came out of bankruptcy. There are cards out there that are just for individuals with bad credit. Be careful because they do tend to charge a high annual fee. And you have to ask yourself, is this important enough to pay $30 or $40 a month or a year for a fee? And so you'll want to start building that credit history again, making payments on time. You make consecutive payments on time for maybe 3, 6 months, and a year, you're going to start seeing substantial changes in your credit report or your credit score. Reducing the balances on credit cards is one of the fastest ways as well. Again, these two items, making payments on time and reducing the balances on credit cards, those 65% of your score is right there. Now, instead of reducing balances, some people say, we'll get another credit card and increase the credit limits. Be careful because, again, you now have a chance to go out and use this new credit. And again, remember, when you ask for credit, those are hard inquiries, and that may negatively affect your credit. Go through and look and make sure that there's nothing wrong found on your credit report. Now, I want you to remember that it likely took just a little bit for your credit to go south. It may take a little bit more for that credit, your credit score, and your credit report to look a little bit better. But you can do this, and likely you can do this without the assistance of paying some outside firm. Not to say that they can't help you, it's just to say that with this information and doing your own research, you probably can do it yourself. So frequently asked questions that I get. Is there a credit score for married couples? The answer is no, there's not. Every individual has a social security number, has a FICO score. They have their own FICO score. Now, married couples may, for example, go and buy a car, and it might be underneath both individuals' names. Then that car loan is going to be on both credit reports, and the payment history will be on both credit reports. Now, if spouse one applies for a credit card and gets approved, then it's only going to show underneath spouse one's credit report. It's not going to show up on the other spouse unless what? They add them as an authorized user, and that's that situation. So there's not three different credit reports, credit scores for married people, the two different individuals and the married couple. They're all, it's just two, each one. Does checking your own credit impact your score? Absolutely not. It's a soft inquiry from yourself. Doesn't affect you at all. Should I buy credit protection insurance? Your credit card companies will offer credit protection, for example, if you lose your job or if you were to die before you pay off the balance. A lot of times this is really cheap, but at the end of the day, it's typically seen as something you probably don't want to do, just because it's a little expensive when it's all said and done. It's consolidating high credit card debt into a single loan a good idea? Usually the answer is no, because in this situation, you're turning unsecured credit card debt into secured debt. So, for example, let's say you have 3 or 4 different credit cards. If you were not to pay those credit cards, no one's going to come take anything from you, right? Your credit score is going to go down, your credit report's going to get beaten up, and that's bad. No one likes that. But in order to consolidate credit card debt, you typically need some type of collateral. The majority of Americans use the equity in their home as that collateral and take out a consolidation loan and pay off their credit card debt. The problem is that a lot of times, in the cases that I've worked with, is those individuals haven't learned their lesson. So they consolidate 4 or 5 credit cards, and the payments they do go down, because you're stretching them over 30 years now, and at a lower interest rate. And while that all sounds good and everything, but now if you don't make your payment, you could lose your house. And so just getting out of the credit card debt in general and getting rid of those rather than consolidating them usually is just a good practice. However, financially, as a certified financial planner, I can tell you that financially, on the number side, it does make sense to pay less interest. But does it always work? Well, it just depends on the person that is dealing with it. So, is no credit file considered bad credit? No, absolutely not. You are considered a ghost in the land of credit, but it's not necessarily a bad thing. Real quick, let's talk about identity theft. And it's something that's happening more and more and more out there, and it has to do with your credit report. So, identity theft can happen to anyone with a social security number. It doesn't matter their age. It could be a child, it could be someone who's 85 years old. It doesn't matter. Credit card fraud tops the list of identity theft reports in 2017. Okay, individuals serving in the military filed the most complaints, a lot of times because these individuals are moving all the time or they're deployed. So it gives thieves an opportunity to attack someone who's really not focused on their credit reports, and sad because they're focused on protecting our country, and so military families, they tend to see this a lot. So the good news is that the FTC reported fewer identity theft complaints in 2017. The bad news is that the amount of financial loss per individual increased. Now, thieves that are stealing identities, they're still using the old methods. Those old methods include dumpster diving, telephone calls, but just make sure that you are keeping your information protected. When looking at all types of fraud, the median loss from fraud in 2017 was 429. So that's the median, that's the number in the middle. There's going to be less and there's going to be a lot more. It's not really always costly in terms of financial, but the amount of hours it takes to fix identity theft is a lot, and emotionally it can be draining. So, how do we mitigate identity theft or reduce a theft from happening to us? Shred all items that include any personal information. It doesn't matter what it is. If it has your name on it, shred it, right? That's just a practice. If you live in an area where it's cold and you need some kindle to start a fire, hey, those work great. Throw them in there, right? Avoid giving out information on the phone. These have risen. A lot of people will call posing as maybe an IRS agent, call as a law enforcement agent, or call pretending to be your bank, right? Don't give out that information on the phone. Your bank's not going to call you and ask you for your social security number. They're not going to email you and ask you for that information. So again, beware of individuals posing as IRS agents or law enforcement. They use that to use a fear tactic that you must provide this information because, hey, I represent the IRS, or hey, I'm a police officer, right? And so make sure that you understand that you don't have to give that information out, nor should you give that information out. So this is something that I beat up the younger generation about a little bit, and that is allow your computer and device to get the necessary updates needed. Remember that there's a reason that these devices need to be updated, and most of the reasons have to do with they just need a patch for security, that there's some type of glitch or there's something that they missed or there's something vulnerable. And so making sure that you have up-to-date antivirus, making sure that you allow your things to update. Be very careful when you're clicking on files, right? There's a reason that it tells you not to open that file, so be very, very careful with that. Review your credit report at least every 3 months. I think that's a really good practice. You also might consider finding some type of credit monitoring service if you're someone who is really, really worried about that. Some banks provide that. Some credit card companies, if you get their credit card that they will allow you to have a credit monitoring service, so it notifies you. That's something you might want to look at because you could be notified immediately if your credit report is checked. It's unfortunate. Individuals are going to go to no ends to try to steal your information and ruin kind of maybe even the hard work that you've done and some of the things that we've talked about today. I do have a list of additional resources here. The CFPB, the Consumer Financial Protection Bureau, they have a lot of information on all of the items that we discussed today. In addition, the FTC, who actually handles identity theft fraud cases, and that's who you report to when your identity is stolen. They have a lot of great consumer information, and some of the information used the National Endowment for Financial Education. They have great lesson plans for adults, but they also have for teenagers and kids as well, and they have a great amount of information. So I just want to take time and I just want to thank you and for spending time with me over this approximate hour and just understanding credit. Remember that credit is your financial report card. It is important. It is used in the real world. And yeah, I hope you enjoyed it. And I just want to thank you for viewing the presentation. Have a great day.